Be ready. 5 seconds. Start. The Reserve Bank of India has been reducing interest rates to fight the economic slowdown. Stop. Accordingly, bank deposit rates are coming down. Stop. Rates on other instruments are also following suit so that the entire interest rate structure falls in line. Stop. Falling interest rates is a global phenomenon as every country is struggling with growth. Stop. While low rates are good for those who want to avail loans, it is not so good for savers. Stop. We discuss here some pockets within debt mutual funds which would be interesting in the current scenario. Stop. Let us see what options you have for fixed income oblique debt investments. Stop. For bank deposits, the rate on a State Bank of India deposit of 5 to 10 years maturity is 5.4%. Stop. The rate on Kisan Vikas Patra is 6.9%, National Savings Certificate 6.8%, and monthly income account 6.6%. Stop. Public Provident Fund pays 7.1% currently, but there is an upper ceiling on investment that is rupees 1.5 lakh per year. Stop. The 7.75% RBI savings bonds have been discontinued. Stop. They may be relaunched, but the interest rate would be lower. Stop. Yields of tax-free PSU bonds in the secondary market are only 4.6% to 4.7%. Stop. Against this backdrop, we will discuss certain debt mutual fund investment options. Stop. Portfolio credit quality is important as you do not want any default risk. Stop. We will mention only those funds that have AAA oriented oblique government security oriented portfolio. Stop. In this context, it is relevant to understand the concept of debt fund portfolio maturity roll down. Stop. Let us say there is a fixed maturity plan with a 3-year maturity. Stop. As per the rules, the maximum maturity of securities in the portfolio can be 3 years. Stop. After 1 year, the remaining maturity of bonds in the portfolio runs down to 2 years. Stop. After 3 years, all the bonds in the portfolio mature and you get your money back. Stop. Since the bonds are maturing, there is no volatility risk. It does not matter to you on the date of maturity whether bond prices in the market are going up or down. Stop. The difference between FMP and open-ended debt funds is that open-ended funds will always have portfolio maturity. Stop. As an example, if a short duration fund has a portfolio maturity of say 3 years today, it will have a portfolio maturity of 3 years even after the passage of 3 years or little bit here and there. Exempli gratia 2.8 years or 3.1 years. Stop. The point is it does not behave like an FMP. Stop. Now the concept. Stop. There are a few open-ended funds which have a strategy of portfolio maturity roll down. Stop. It is a decision taken by the AMC to run a fund with that positioning. Stop. In an FMP, there is no redemption facility available with the AMC. In open-ended funds, you can redeem, that is, liquidity is available to you. Stop. The advantage here is your volatility risk is progressively coming down with every passing day stop. There would be some volatility as of today, but you need not worry. You just have to hold on to the fund stop, since every investor would not be aware of open-ended funds run with a strategy of portfolio maturity roll down. We have mentioned these funds briefly. Stop.